How to analyze a stock in under 10 minutes. Most people spend hours analyzing stocks and still lose money. But what if I told you there's a 10-minute framework that separates winners from broke retail traders? I'm about to show you exactly what professional investors look at. And it's way simpler than you think. Let's get into it. First, understand this. You're not trying to predict the future. You're trying to find companies with good fundamentals that the market hasn't fully priced in yet. That's it. That's the game. Here's your 10-minute roadmap. We're breaking this into 3 parts. And by the end, you'll be able to look at any stock and know whether it's worth your money. Part 1. The business itself. Open up your brokerage, whether that's Fidelity, Robinhood, or whatever app you use, and look up any stock. Let's use Apple as an example because everyone knows it. First thing, what do they actually do? Seriously, if you can't explain the business in one sentence, skip it. Apple makes phones, computers, and services. Done. You understand the revenue. Now pull up the price to earnings ratio. This is your gateway number. PE tells you how many dollars investors are willing to pay for every dollar of earnings. Apple's PE is around 28 right now. Microsoft's is around 35. APE under 15? That's cheap. Over 25? That's expensive. This isn't magic. It's perspective. Here's what most people skip. Compare that PE to the broader market. The S&P 500 average PE is usually between 18 and 22. If a company's PE is way higher, you're paying a premium. Make sure the company actually deserves it. Next, check earnings growth. Go to the Financials tab. Look at the last 4 quarters of earnings per share. Is it going up? If Apple earned $2 per share last year and $3 this year, that's growth. Companies with growing earnings justify higher prices. Companies with shrinking earnings? Walk away. Spend 2 minutes here. That's your first fundamental check. Part 2. The balance sheet. Now we're looking at the company's health. Think of this like checking someone's credit before lending them money. Pull up debt to equity ratio. This shows how much the company borrowed versus what they own. A ratio under 1.0 is generally safe. Over 2.0? They're leveraged heavily. That's riskier. Look at cash on hand. Apple has about $160 billion in cash. That's insane security. A smaller company with barely any cash reserves? Much more vulnerable. If the economy sneezes, they're in trouble. Check free cash flow. This is the money the company actually generated after expenses and investments. Earnings can be manipulated with accounting tricks. Cash flow? That's real. If a company shows big earnings but zero cash flow, something's fishy. Here's the trick. You're not doing forensic accounting. You're looking for red flags. Is the debt growing? Is cash shrinking? Is free cash flow negative? If you see those, move on. 3 minutes max here. You're screening, not analyzing like a CPA. Part 3. Momentum and catalysts. This is where timing meets fundamentals. Look at the stock price over the last 6 months. Is it up? Down? Why? Check recent news. Did they just announce a new product? Did management change? Was there bad guidance? You need context. Check the 52-week high and low. If a stock is near its low and the business is solid, that's interesting. If it's near its high and the PE is stretched, be cautious. Here's the real talk. Don't buy a stock just because it's cheap. And don't avoid it just because it's expensive if the business is crushing it. You're looking for undervalued growth or quality at reasonable prices. 2 minutes here. Scan the news. Check the chart. Form your opinion. Your decision framework. Solid business? Check the PE and earnings growth. Good balance sheet? Check debt and cash. Reasonable timing and momentum? You've got a candidate. This doesn't guarantee you'll make money. The market is unpredictable. But this framework keeps you from buying garbage and holding it in your Roth IRA for years hoping it recovers. Most people skip this analysis entirely. They buy based on tips, memes, and FOMO. And that's why most retail traders underperform the S&P 500. You now have the framework. Use it. Practice it on 5 different stocks this week. It'll become second nature. If this helped you, subscribe right now. We drop new investing frameworks every single week that actually move your wealth. Hit the notification bell so you don't miss the next one. Go analyze a stock. Let's go.